Sorry about that. I am muted. So, hello and welcome, everyone. My name is Cooley. I am the Targeted Outreach Director for the California Department of Financial Protection and Innovation, also known as the DFPI. Welcome to our webinar. I want to give everyone let's give them 2 more minutes to jump in. I know it's right at noon and people are just getting off work for lunch. Some people are getting their lunches. So, 2 more minutes, we'll jump right on. Thank you. All right, I think it's time to get started. We have a lot of really great content, and it looks like a lot of attendees are jumping in. So let's just go ahead and get started. Again, my name is Cooley. I'm the Targeted Outreach Director for the California Department of Financial Protection and Innovation. It's a long name. We just go by the DFPI. Uh, Thank you for joining this webinar. Today's financial education topic is building generational wealth with investing. This is a part of investing series funded by a grant from the Protection Trust, also known as the IPT. Let's jump right in. A lot of great information today. And of course, thank you for joining too. So just a quick disclaimer, your cameras and microphones have been turned off for this webinar, but if you do have any questions, please put it into the Zoom's Q&A feature. I have a dedicated time at the very end to answer your questions. And there was a number of questions that was submitted to us during the registration process. Please feel free to submit your questions and we'll answer it then. The views and opinions expressed in this presentation are those of the presenter and not necessarily those of reflecting those of this department. This presentation is for educational and informational purposes only. This is not financial advice. We're a big proponent of individuals, consumers doing their own research. And, by being here, that's kind of what you're doing. You're doing your own research. So thank you. The DFPI does not assume responsibility for the completeness of the information presented in this presentation, but I did double check the slides today, and this is as updated information as it is the day of the presentation. So for more information, you could always visit our website, dfpi.ca.gov. We also have a in outreach inbox, which you could always mail if you have more questions, you want a copy of the slides. Our email address is outreach@dfpi.ca.gov. Okay, just real quickly, talking about the DFPI. Who are we? What is our role? What do we do? We are California's state financial regulator. Our purpose is to maintain a fair, healthy, and trusted financial marketplace for all Californians. We do this by regulating and enforcing a variety of financial laws and overseeing financial services, products, professionals, industries. We also provide presentations throughout California to provide consumers, to inform consumers, create awareness, and prevent them from falling prey to frauds and scams. If you do want more information, you can go to our website again. It's dfpi.ca.gov /consumers. That's kind of dedicated page for consumers to get a lot more information about what we do and who we are. Okay, let's jump right into it. First, let's talk about generational wealth. What is it? Generational wealth is wealth that is passed on from one generation to the next. Usually, it emphasizes long term financial well being, right? Ensuring that future generations have financial stability and opportunities. I like to tell everyone that generational wealth is a head start. It's wealth you're passing on from one generation to the next, and it's really giving that next generation that head start, right? An extra step. We'll talk a little more about that. So a couple different examples. I apologize for that. Should have put my phone on silent. A couple of different examples of generational wealth. Financial wealth. It's the most common thing. You know, cash is king. And examples of financial wealth being generational wealth is obviously money, any kind of savings, investments you might have made, bonds, stocks, that kind of thing. I like to plug Scholarshare 529 here. It's an amazing program. If you haven't looked into it, please look into it. It's a great program to help others save for college. And it's that kind of financial wealth that you can pass on from one generation to the next. Assets, right? If you have a house, other real estate that you've invested in, collectibles, precious metals, those are examples of generational wealth, which you can pass on to beneficiaries. Business ownership. A lot of people don't think about that, but if you have a business, you could always have your beneficiaries inherit it, or you could sell the business, and then, of course, the proceeds could go to your beneficiaries. Intellectual property. Another thing a lot of people don't think about, if you have patents or copyrights, certain trademarks, you know, maybe you own some historical art that you created, right? All those rights can be passed on to your beneficiaries, but there's a lot of nuance that goes into it. We are, for this webinar, we're going to be mostly focusing on financial wealth that can be created for generational wealth. So let's talk a little more about the power of generational wealth, right? Why generational wealth? Well, again, I talked about how generational wealth is a head start for your beneficiaries, right? You could, you know, your beneficiaries could use the financial wealth that you pass on to do things like buy or pay for a house, right? They can use it to pay off debts. They can use it to go to college, get a certification, pay off student loan debt, or do that educational thing that they would have not had the option of. They could use that, you know, generational wealth to create or increase their own emergency fund. They could also use that generational wealth to start that business they always wanted to start, right? And the other thing, again, generational wealth doesn't have to be used up in one generation. It can actually be saved and then passed on to future generational wealth. Generational wealth really, especially if you're thinking about creating and having generational wealth in your bloodline and your continuing legacy of beneficiaries, it is kind of that first pebble that starts the avalanche, right? um, and that's all what generational wealth is. And the definition of every generation who takes on the wealth, obviously you can pass it on in many different ways. But again, what I like to tell individuals when we talk about generational wealth is it is options at the end of the day, right? When you have wealth that is inherited, it opens up a lot of different options to what you can and what you can do, right? Again, maybe you always wanted to start that business, but you didn't have the money. Maybe you always wanted to buy a house or pay off a house, but you don't have the money, right? Generational wealth could be that down payment on a house. So let's go ahead and start talking about investing then, right? Um, Obviously, creating that generational wealth is starts with investing smart and investing wisely, and that all starts by investing with a purpose. Again, doing your research, knowing your priorities, finding that strategy that helps you focus on achieving your long-term financial goal. And if your long-term financial goal again is to build generational wealth, it's not trying to day trade. It's not trying to catch those quick up and downs. You're trying to build wealth over time. And that's long-term investing, right? So investing with that purpose of building generational wealth. Again, Becoming a smart investor, you can identify and avoid investment frauds and scams, right? It'll help you be intentional about the different types of investing decisions you make. It also, being a smart investor allows you to understand the different types of investing fees, taxes, and risks that are involved. It also, by investing long term, by being a smart and a wise investor, you could cut out a lot of that unnecessary stress about the different market conditions, right? Long term investors don't actually care about those short term drops in the market, right? Um, we look at long term growth. We think about, hey, it's down now, but we know it's going to go back up. So and the other thing is, being a smart investor, you can adapt to changing market conditions, right? New markets come out, old technologies fade away. Being a smart investor, you can shift your investments as you do your research and better understand what your financial goals is. We have a whole, by the way, we have a whole webinar we recorded on how to invest wisely. It's a fantastic webinar. Please go to our YouTube channel, check it out, learn more on all the different tactics and strategies you can employ to be a smart and wise investor. Um, so a couple of questions to ask before you start investing. And again, I do want to let you know, if you do have any questions, please feel free to put it into the Zoom's Q&A feature. We have a dedicated section at the very end where I'll be answering your questions. And also I'll be answering questions that were submitted to us. So questions asked before investing: should I be investing now? Right? that's usually the first question people skip, which is, a lot of people just want to say, I want to start investing. And I always tell them, hey, how is your housing and living expenses? Have you started budgeting? Do you understand how much you can invest or should be investing, right? Consider paying off that high interest debt before you start investing, because if you have a 25% credit card, 25% interest on your credit card balance, it doesn't make sense to be putting $1,000 into an investment that's only returning 5% when you're paying 25% interest on $1,000 credit card bill, right? So you're actually losing money. It's better to pay off that high interest debt, and then you can start using that money, any extra income, to invest. How much can you afford to risk and lose? Again, don't be taking your rent or mortgage money or the money you're supposed to be using to buy groceries to invest, right? How much can you afford to risk and lose? What are your long-term investing goals? Again, we talk about building generational wealth is my long-term investment goal, but you should also consider things like, what kind of investments are going to align with my retirement, right? And that kind of thing. And that leads us to, what are my investment priorities? Do I want to have an investment or investments that I have to maintain regularly, right? And when I think about this, I usually use the example of real estate. I know a lot of people want to get into real estate investing, but it is not easy at all. There's a lot of work required to be a landlord. Even if you're kind of a passive landlord, like you have a company that is managing your properties for you, he still requires your work, right? Maybe you just want to get into something you put money into and it grows steadily. You have maybe a financial advisor or an investment advisor who watches it for you. Again, those are your investment priorities, right? And then thinking about, how much time do I have before I can start withdrawing on those investments, or when does my investment mature, right? Those are kind of those investment priorities that you need to ask yourself and figure out. Okay. Um, let's talk about getting started with investing. This is one of the biggest questions that I get whenever I do these workshops or when I talk to consumers. A lot of people ask me, how do I get started? And I always tell them, hey, look at your current employer, right? Look to them. Do they have any kind of employer sponsored plans? So things like a 401k, 403b, 457b, all those kinds of things. Look at their plans, and I would say most times 401ks or those investment plans, those retirement plans, they have some kind of match, even if it's like a 1% match, which is like kind of nothing. But if you're investing $1,000 a year on 1%, that's $10. You're getting an automatic return. You are. and that's free money that your employer is giving to you, right? I used to, way a long time ago, I used to work for a company that had a 50% match, and that was an amazing match. So every dollar you put into your 401k, they would put 50 cents in. And everyone I knew was maxing that out because that's free money. That's free 50 cents for every dollar. So look, that's kind of the very easy way. And sometimes a lot of these plans are easily managed. You just tell it what I want it to do, right? These are I want to be conservative, or I want it to be a little aggressive, or maybe you have different investment goals for it. But it's kind of a very easy thing to do. You don't need to do too much. It's already tied into your employer. I do recommend every year you check on the performance of your retirement plan, make sure it's kind of meeting your goals. Um, Outside of that, you could always start up a Roth or traditional IRA account. If you have if you have a bank you're working with, I'd say start there. Bank, credit union, see if they have a Roth or traditional IRA account that, if you're interested, you could open up with them. The reason being is, if they do have those types of options available, it's easy to transfer money from one account to the next, right? But there are brokerages and financial certified financial provider professionals that can help you start up those Roth and traditional IRA accounts. And obviously, like I said, you could always get help from financial advisors and investment advisors. Just make sure they're licensed and certified and that they're legitimate. Don't always go with the first one you find. Okay, don't always go with that person that's recommended by a family member. Do your research, check on them, and then of course get references, and always get different quotes. Right, go to different financial advisors and figure out, how does this person do their business, what's their philosophy, right? Do they charge certain fees? How does those fees compare with another financial advisor's fees, right? So again, do your research. It's so important. um, what to look out for when you start investing. Investment red flags we'll talk about in slide 7, but there are a lot, so you want to be careful. You want to do your research. And of course, another question I get a lot is, hey, how much should I invest? General rule of thumb is 10 to 15% of your annual income. And of course, that depends on your financial situation. That depends on a number of different factors. But if you can, generally 10 to 15% of your annual income. Okay. So why invest long term? And usually it's self-explanatory, but let me just talk about long term. Is If you're investing long term, there's usually less risk associated with that, right? You're not trying to catch the latest investment fad or the latest, you know upswing, or those different. You're not trying to catch the wave, and then getting caught short, right? Instead, you do your research, find out what those long growth investments are, and get into that. So again, reduced risk. Short-term investing obviously is very more susceptible to that market volatility. You're going to have a lot more stress when that happens. We're going to talk about compound interest in the next slide, but just an example, with a 10% return, you can turn $100,000 to 1.6 million in 28 years, right? That's a very rough math, but we'll talk a little more about the next on the next slide. Again, less emotional decision making when you're investing long term, right? You're looking at 1 year, 5 year, 10 year increments, instead of how's my stock doing on a daily basis, which is going to get you really stressed out. And long-term capital gains are usually taxed differently. Most times it's lower than short-term capital gains. Again, I'm not a tax professional. This is not financial advice, but definitely you want to look into it. When you start investing, you want to see what are the tax implications when you start withdrawing from the investment and when you pass that investment on to the next generation. All right, compound interest. In one of my investing webinars, I totally forgot to include this slide, but this slide is so important. I love to show this slide to high schoolers when I do workshops with them, because a lot of them don't really understand how compound interest works, and how, if they start really early, you can grow wealth very easily. So let's, in this example, start out with $50,000 investment. Okay, we're not adding anything else. We're not investing monthly or yearly, nothing. We are just starting out with $50,000. We're investing, in this example, we're investing in something, any kind of investment that has a 8% annual rate of return. Now, I say 8%, but it's more like an average, right? One year it could be 10%, another year it could be 6%, but I'm going with like an 8-year annual rate of return average. All right. In your second year, right? Because you bought the investment, it's $50,000. Second year, you made $4,000 interest. You did not do anything. You just put $50,000 in an investment, and at the end of the year, you get $4,000. That's not bad, right? Year three, you could see that it slowly starts to build, right? Instead of $4,000 interest, now you get $4,300, $320. And then you see that it grows, right? Year four, we got year five. So in what, couple of years, about 3 years, you went from making $4,000 in interest to now you're making $5,000 in interest. Actually, a little over 5,000, right? Let's do a little bigger time skip here. In 10 years, doing nothing, just literally doing nothing. You just have $50,000 sitting in investment, and it's returning an average of 8% return. Your investment now is making almost $8,000, right? So it doubled the interest that it's giving you per year, and you go from $50,000. So in 10 years, it goes from 50 to 107, almost $108,000, right? That's 10 years of doing nothing. It's just sitting there in investment, right? Do a bigger time skip. So year 20. So in year 20, now your investment is producing 17,000, a little more, like 17 and some change per year in interest. And the total amount at the end of the year is $233,000. You didn't do nothing. I'm not putting money in. I bought this thing 20 years ago and it's just been sitting. Let's do one more time skip. By year 30, your investment, that $50,000 investment you made, it's now bringing in $37,000, a little more than $37,000 a year in interest for you. And the total amount is at the end of the year is more than $500,000. So in 30 years, you've turned 50,000 to 500,000, and you didn't do anything but let it sit, right? This is compound interest. And the one thing I tell students is this actually works in reverse. If you have a debt and you have like 8% interest and you're just not paying on it, that debt will grow. It'll double basically every 9-10 years, right? So be careful. Debt, try to pay it off as much as you can, as fast as you can. But with an investment where you just let it sit and slowly grow over time, you can make it absolutely. You'll have basically $500,000 in 30 years. I joke about this with my wife because we have a son that's very young, and I told her, hey, if we just set aside like $50,000, by the time he's ready to buy a house, he'll have $500,000 just sitting there ready for him. And we don't need to do anything, right? Which, by the way, if you just continued this numbers, by year 40, it'll be about 1.3 million. So just letting you know, this is how compound interest works. If you want to know more, we actually have a rate of return calculator on our investor center website. There's a link to it. You could go, that's not a link to the investment calculator, but that's a link to our investor center resources page, which has the calculator. dfpi.ca.gov/investing-resources. You could also look up the rate of 72, the rule of 72. It talks about the doubling of an investment. Okay, let's talk about passing on wealth, right? We talked about the power of compound interest. One thing that we don't actually, there's not a lot of people talk enough about is when you retire and you're withdrawing from your Social Security, right? Don't burn through your investments. A lot of people try to rely too heavily on their investments, right? Let's just say you have $1 million that you've saved up over a lifetime of work, and you've earned it. Don't A lot of people think that they're going to use that $1 million, they're going to draw on it and use that money during retirement, which you can, but the problem is, if you burn through that $1 million, you won't have anything to pass on, right? So a 500,000 investment that you've made over your lifetime, right? Maybe it's worth a 401k or something. A 500,000 investment with 8% annual return. it'll generate about $40,000 of income for you. That's the interest, right? And you could use that $40,000 to help support your Social Security income and maybe other investments that you might have, right? You could withdraw that $40,000 without touching that initial $500,000 investment, and every year your investment will continue to give you $40,000. On another example, if you had $1 million in investments with the 8% return, that'll generate $80,000 of annual income for you. And the idea is to only use that rate of return, right? Only use that annual income. Don't touch that $1 million or $500,000 or whatever principal you have, um, because you don't want to eat through your investments, so that you don't have anything to pass on. And consider only withdrawing your rate of return or less, right? So think about that. If in this example here we have $500,000, if you withdrew $100,000, the next year you're going to have a less rate of return, right? And that's what I don't want to happen, because you'll go from $40,000, your investment creating $40,000 a year, to less, probably something like 30,000, 35,000, something like that. So again, don't touch your principal. In fact, if you can, you want to withdraw less than the total income, because you want to try to maintain that compounding effect. You want to leave your principal investment to, again, continue to grow. You want to also have that principal continue to provide you annual income, right? And then, of course, you want to have something to pass on to your beneficiaries. Don't have investments and then burn it all during retirement, and then have nothing left to give your beneficiaries, right? Um, let's talk about part two, passing on your wealth, right? You want to definitely have an estate plan in place. Things like a trust, a will, transfer of deed on death. Sorry, transfer on death of deed. That's a whole thing. It's basically passing on real estate to your beneficiaries. Look into it. If you don't have a will, if you don't have a trust, if you don't have any of that, definitely want to get that estate plan in place. Consider life insurance and the power of attorney. I would definitely, you don't want to pass on wealth, but then have your beneficiaries use that wealth to pay for your last wishes, right? Your funeral expenses, that kind of a thing, because that's definitely going to be a lot of stress on them. Um, we have a, by the way, we shameless plug here. We have a webinar happening in September 4th. I know you can't click on this link, but I will include a copy of the slides in my follow-up email. Estate planning, leaving a legacy. We're going to have a webinar just like this, September 4th, 12 p.m. at noon. Register for it. I'm bringing in a professional. I believe she's a lawyer. We're bringing in a professional who does estate planning, and she's going to talk all about estate planning, right? I'm not a tax professional. I'm not a estate planner of any kind, but I am going to get a subject matter expert to come in and talk a lot more about it, things to consider, that kind of stuff. So register for that webinar. Oh, there's a link to it there. When you're setting up your estate plan, you definitely want to determine your beneficiaries, but you also want to make sure you continually update your beneficiaries, right? Let's say that you want to pass on money, stocks, wealth, whatever you have, to your grandkids. Well, if you have that plan in place, but then your children continue to have grandkids, you want to make sure that you are giving something to all your grandkids, right? So determine your beneficiaries, keep them updated. Consider the tax implications of that wealth inheritance, right? Giving that next generation wealth, but then not burdening them with huge taxes. And also, like I said, you want to definitely review and uh, update your will, update your estate plan every year, because things change, right? People move. Other people that you might be considering giving them money, they might pass on. So review and update your estate plan every year. Okay. Last part, passing on your wealth. So important. Share your financial wisdom. Okay. Over your lifetime, you have gained knowledge and wisdom on finances. empower your heirs, right? Give them that knowledge and skills they need to manage and grow the wealth that you hand off to them, right? Um, talk to your kids about money. Talk to your grandkids about money if it's that's the case. Use money lessons, right? Share your financial experience so they can understand it. You definitely want to lead by example if you can, right? You want to inspire others, so that's like giving to charities if you can, right? Um, Provide mentorships, right? That's so important. You would be surprised how much young adults, right? I do a lot of workshops with high schools, at libraries. You would be surprised how many young adults want financial education, financial literacy. They're hungry for it, because a lot of them don't understand, again, financial literacy or the rules of money, right? And they become victims to predatory lending, to contracts that they sign. So provide mentorships if you can. And of course, promote any financial literacy program that is out there, including this, other nonprofits that have programs. Find out about it, promote it, volunteer for it, right? Okay, investing. Again, I talked about doing your research. It's so important. You want to check before you start investing, right? Make sure it's a legitimate investment. Make sure you're using licensed brokers, that kind of thing. You could use us, by the way. We have a checklist that you can download to help you check your investment, make sure it's legitimate, make sure it's licensed with the correct agency, that kind of thing. You can also use the SEC's Edgar database. So the Security Exchange Commission has a database of investments and investor advisors that you could check to make sure they're good, make sure they don't have any legal actions pending against them. You want to use legitimate investment resources, right? TikTok, I would argue, is not a legitimate investment resource. I wouldn't even say YouTube is either. There's a lot of people spouting financial nonsense on YouTube. So I would definitely say do your research, use legitimate resources, things like the SEC's investor.gov. So good. It's very dense. They got a lot of information, but it's a great place to start and get more information. The FDIC has a program called Money Smart. Check that out too if you want to learn more than just about investing. They got a lot of different other topics. And of course, I have to again shamelessly plug the DFPI's Investor Center, very much modeled after the SEC's investor.gov. But we kind of we make it a lot simpler and easier to digest. So again, talking about the Investor Center, you could go to dfpi.ca.gov/investors. This is what that homepage looks like. Easy to navigate. Information is quick and easy, very accessible, and then easy for. That's the whole point, making easier for consumers to get information quickly and understand it. All right, I did promise to talk about some investment red flags. So, when someone's trying to promise you high rates of return or no risk, every investment has a risk. So that's a huge red flag. If someone is claiming consistent returns over many years, that's a red flag. If someone's trying to pressure you, hey, you got to buy this now, otherwise you're going to miss out. That's definitely a red flag. Again, I talk about long-term investments, not catch the wave on this, right? Let's get the let's get the hot stock of the week. That's not what you want to do because again, could be a scam or fraud, or could just be some way they're pumping and dumping that stock. If someone is insisting you to be silent or secret about investment opportunity, that is huge red flag. Lack of communication, contact information, or transparency, another red flag. Errors or inconsistencies on documents, another red flag. Claims of exemptions, definitely red flag here, right? They're saying, oh, this investment is tax exempt or that kind of thing. Definitely want to look into that. A history of problems, right? You want to look at investor in the investment as well as other investors, what do you call it, testimony. And then, of course, you want to look at the reputation of the investment company or the investment or even the investment broker licensee, making sure that they're licensed, right? Um, Again, we talked about reputation and testimonials. You want to make sure it's really good and make sure the testimonials are legit, right? If an investment is publishing testimonials on their website, I would take that with a grain of salt. You definitely want to look at third-party organizations for checking out, the legitimacy of those testimonies. Um, here's a big one. If you're into an investment and they're asking you for more money, that's a big red flag. Um, and if there's any kind of there's no paperwork, this investment is a handshake only. That is definitely a lack of paperwork. Okay, just a quick thing. Talk about how to get more help. Right. Again, consider using a licensed investment broker or advisor. Uh, you could always use the SEC's Investment Advisor Disclosure portal right there. You could also use FINRA, right? They're a great organization to check on a broker. Their link is there as well. And you could always check the DFPI's enforcement records on investments, advisors, different investments, that kind of thing. There's a link right there. And finally, I don't say this enough, but I definitely need to. If you have an issue, if you've observed a scam or fraud, if you've been a victim of a scam or fraud, you could always submit a complaint to the DFPI. We will look into it. So the link is dfpi.ca.gov/submit a complaint. So please let us know if you've seen, observed, been a victim of any kind of scam or fraud. So you can go there. Okay, Q&A session. Um, I do not have any live Q questions right now. So again, a reminder: if you do have any questions, please submit it into the Zoom's Q&A feature. I will answer it. For now, since we don't have any questions, let me go ahead and pull up some of the questions that were submitted during the registration. Let me take a look here. Uh, are there different investment strategies for short-term versus long-term generational wealth? I okay. Are there different strategies for short-term wealth versus long-term? Yeah, definitely. So if we're talking about short-term, I would not recommend it because first of all, any kind of short-term investments is usually takes a lot of maintenance. You could get something like a 5-month CD, right? Certificate deposit. You could get like a 12-month CD, and that's not bad because it's very low maintenance. You just give a CD, you let it all the way to the maturity, and then you take the money out, right? That's kind of a short-term investment. And there are definitely a lot of benefits to something like that. But if you're trying to get into like day trading, that's not a way to build generational wealth because there's just so much risk. There's just so much risk involved. And I think that's kind of what it comes down to, right? The different strategies, each strategy has, again, all investments have risk. And each strategy, most short term strategies have a lot of risk, but long term strategies usually have less. And if you're trying to build that wealth that you could pass on, you want very low risk. I'm not telling you to go out and get like a 30-year CD or buy a 30-year treasury bond. That's not what I'm trying to say. What I'm trying to say is consider the risk and then consider what your financial goals are. Um, yeah, I hope that answers that question. Um, okay. Oh, got one that came in. How do I know if my current financial situation allows me to start investing long term? Oh, this is a kind of a relatively easy question, um, but it can be complex. So, how do you know if your current financial situation allows you to start investing, and especially long term? That was in parentheses. Um, so, number one, budget. Budget. So important. It's kind of the place everyone should start at. Um, because your budget's going to tell you a lot of things. It's going to tell you how much money you're bringing in. It's going to tell you how much money you're spending on expenses, on debt. It's going to show you what you're spending your most money on. And then, of course, it's going to tell you how much money do you have left at the end of the day, week, month, that kind of a thing. That money left over is money that you can use to invest. And if you want to prioritize investing, right, especially long term, you could definitely add a line item into your budget to make sure you're investing and continually investing and consistently investing, right? So, budget. How do you know if your current financial situation allows you to start investing? Budget. You want to start budgeting. If your margins are too thin, again, you want to focus on those essentials before you start putting money into investments. You want to focus on paying off that high interest debt, right? And cut expenses, right? That $15 a month Netflix subscription could actually be 15 bucks that you're putting into your investment. So just think about that. Great question, though. Okay, no other live questions right now. Let's take a look at this. What are some of the investment types, such as stocks, bonds, real estate, suitable for building generational wealth? Good question. Again, not a financial advisor, so uh, the high level question is the high level answer is it depends, and of course, it depends on your financial goals and other priorities you have. Right? What are some of the investment types best for building generational wealth? It depends on you. It depends on your beneficiaries. Right? If you want to get into real estate investing, but your beneficiaries, so I'm thinking like your kids, your grandkids, if they have no interest in real estate, then and that's your plan to pass on the real estate, that might not be compatible, right? Of course, they could just liquidate all the real estate and then have the money to do whatever they want. But yeah, I would say that's a great question, and you want to talk to your beneficiaries about that, right? You could say, hey, I have these long-term investments. Is this compatible with your own financial goals, your own financial priorities, right? Do you want to take over my real estate investments, right? Do you want to take over my investment accounts? Do you want to take over my business that I've poured 20 years into, 25 years into, that kind of thing? So yeah, the answer here is depends, and it depends on your dependents. Good question though, very good. Okay, how do I communicate my long-term investment goals and wishes to future generations? Great question. Great question. A will should do it. But there are many different ways, right? Just sit them down and talk to them. Say, hey, I have these stocks I've been holding on to. I have some Apple stock that I bought when it was nothing, and now it's like, I don't know, worth a lot. But I don't want you to sell it. I do not want you to sell it, especially when I pass away. I want you to hold on to it, and maybe it's got great dividends. I don't know. I want you to hold on to it till it's worth triple or something. Let them know, right? Put it in writing, put it in your will, let them know. Um, because to be honest, if they don't have it, if you don't tell them what you want, they're not going to know. So how do you communicate? I'd say directly. Communicate directly to your beneficiaries and let them know that's your wishes and goals with your investments that you're passing on, right? Good question. Thank you. Um, let's go ahead. I'm gonna answer a couple more questions and then wrap up. But if you do, again, anyone here, I know there's quite a few of you here. If you do have any questions, please submit it to the chat. I will answer it. Uh, how do I best develop a diversified investments? How do I best develop diversified investments for long-term growth and generational wealth? Really good question, and I'm not a financial advisor, right? So, and this is not financial advice. This is just educational, informational only. So you're thinking correct here when you're saying diversified investments. You do want to diversify your investments. If you want to put it all in stocks, that's fine, but you definitely don't want to put it all in one stock type, right? Let me give you kind of a very grossly high level overview. You don't want to buy stocks in typewriters, right? All of my stocks are in typewriters because that's probably not an industry that's growing. So, yes, diversified investments very important for long-term growth and generational wealth. Again, I'm not a financial advisor. I would say look at your financial goals. If you are thinking about retiring and then passing on this wealth into the future, right? Think about those maybe emerging. I wouldn't put too much money into it, but consider those emerging technologies, biotech fields. Just look into them, and I wouldn't put a lot of money into them, but hey, one or two here and there. Don't risk everything, right? Don't put all your eggs in one basket, but yeah, you could definitely try it out and see how well it does. How best to develop a diversified portfolio? Talk to a financial advisor, especially if you're not financially savvy, if you're not following the market, get an expert to tell you. Pay for their time and get that advice, and yeah, hopefully they can help you build that diversified portfolio. Again, for long-term growth and building generational wealth. Okay. Last question here. Let's see the time. Yeah, last question here. Okay. How can I factor in inflation when planning for the long term? Okay, really good question. I actually get this question quite a bit when I talk about investing and when I do these investing workshops, right? How do I factor in inflation? Well, general rule of thumb is to calculate 2 to 3%. You could go higher. You could calculate 4 to 5%. What does that mean? Well, that means that um, let's say you have an investment, and this is easy round numbers. Let's say you have $1,000, or no, sorry, let's say 100,000. You have $100,000 in an investment, and it is making 8% per year. Now, you could just withdraw that, uh, income at the end of the year, which I think comes out to what, $80,000, $100,000. Yeah, it's like $8,000. Um, you could just take all of that out, but what's going to happen is that 100,000 that is your principal, it's only going to make 8,000 the next year, right? If the interest is still 8% that year. So the problem is with inflation, as you know, with the rising cost of goods and services, that $8,000 that you're going to get next year is not going to have the same buying power that it did this year. So what you usually try to do is factor in 2 to 3% variance. So again, instead of taking that full 8% out of your uh, income, your interest income that came to you, you only take out 4%. You maybe take out 5%, right? Or less. You're just taking out a little bit to help augment, to help support your Social Security income, and leave the rest in your investment. So instead of having 100,000 making interest now, you have 100,000, like 101,000, right? 103,000, something like that. So it continues to grow and stay with the rate of inflation. Again, the last thing you want to do is eat into your principal, right? You don't want to eat into that 100,000, because if you do, you're going to be making less interest per year, to the point where you're just going to be burning it all down, right? You're going to be burning down all the money, your retirement, your investment money, and then when you pass on, you have nothing to pass on to your beneficiaries. So consider that. Okay, great questions. We are almost at the hour, so let's just wrap this up very quickly here. Reminders: 3 different webinars happening in the next couple of months. We have how to pay for higher education, trade schools, and apprenticeships. That's going to be a great webinar. Share it with others. Join, register, share it with others, because we're going to talk again about student loans, but we're also going to talk about trade schools, and then of course apprenticeships. Right, will be the Department of Industrial Relations will be there. They're going to be talking about apprenticeships, their apprenticeship programs. It's going to be fantastic. Please register and join. I think that's about 2 weeks from now, so please make sure to join that one. We have protecting and managing your online data, another really good webinar. We're going to talk about all the difference. We're talking about data brokers who sell your data. We're going to be talking about closing those ghost accounts that you might have, and data breaches, and how your personal data is out there if you don't close all that down and erase all your personal data. So register and join that webinar. And finally, in September, again, September 4th, we have our estate planning webinar. Please be sure to register and join that one if you want to learn all about estate planning, different options, tax implications, all that kind of thing. And finally, of course, got to plug our newsletter. Many of you are probably joining because you saw this in the newsletter. So dfpi.ca.gov/subscribe if you're not already subscribed. And we do have our YouTube channel, which, by the way, this webinar is being recorded and it will be published to our YouTube channel. I will also, for everyone who registered, I will also send a follow-up email, which will have a link to this video on our YouTube channel, and it'll also have a copy of the slides. So thank you. Thank you for joining. Thank you for being here. Thank you for all the great questions. Thank you for being a subscriber and joining and sharing this information with others. With that, I do want to say have a great 4th of July weekend. And I will talk to you all later. Please take care of yourself and each other. Goodbye.